Good morning, ladies and gentlemen. Firstly, I'd like to start off by thanking Westpac for their generous support of my Nuffield Scholarship. I really appreciate the opportunity that I've been provided, and without Westpac and all of our sponsors for all of the scholarships, none of this would occur. I'd also like to thank Nuffield New South Wales and Nuffield Australia for the faith you've shown in my selection, and also for coordinating the program in what has been a very challenging 2.5 years. I'll just start off by giving a brief background of myself and the farming operations, a little bit of an overview on the historic performance of Australian farmland, the influencing factors in farmland movements, price movements, some risks and rewards I've identified in investing in farmland, and related learnings from the study. So briefly, I have a background in price risk management in operations within corporate agribusiness. I moved back home to my farm in 2017, got married a year or so later, and now we've got a young son, Jack, and a little baby girl who's due in a few weeks, so that's why my wife is unable to be here. But I'm very grateful for all of my family's support, particularly on the Nuffield journey. We run 1,200 Merino ewes, plus some lambs and some trade wethers. I'm gradually increasing the production capacity of my farm up to about 4,000 DSE. So why the interest in farmland? There's a bit of a story here. So in 1993, I was 10 years old, a nearby farm was for sale. So I mapped out 3 kitchen floor tiles by 3 kitchen floor tiles, and with some help from mum and dad, I worked out that square metre was worth 6.2 cents. So I started saving a few dollars trying to buy a bit of land. Today, using a conservative value, that same 1 square metre is worth $1.48. That's a multiple of 23 times. So I've had an interest in farmland for a fairly long time. More recently, when the opportunity came up for me to look to grow my business, I turned what was an occasional interest into a more in-depth study. So I started going through sales that I was familiar with and trying to track trends and standardise things such as stocking rates, yields, and yields over time periods. I kept asking myself, do I need to buy land to grow my business? And the answer was pretty simple. It was actually no. But the next question is the really important one. The next question was, is buying farmland a good investment, and what are the risks and rewards of doing that? This became the question for my Nuffield study. So if we just look back, here's some data that has been provided by Rural Bank generously. This goes back 26 years. And we can see that land prices appreciating isn't a recent phenomenon. But certainly over the last 5 years, it has found another gear. My studies find that this is similar in both the USA and Canada, albeit at slightly different rates. To put this in perspective, land purchased in 1996 at $1,200 a hectare is now worth around $7,000 a hectare and has a 26-year compounded annual growth rate of 7.5%. Rural Bank's 2020 report calculated a 20-year compounded annual growth rate, or CAGR, of 8.4%, and 5 years, finishing in 2021, at 12.5%. As a comparison, Sydney residential real estate has a 30-year history of averaging 6.5% and a 5-year average of 8%. So agricultural farmland is far outstripping Sydney residential real estate. CPI over that 26-year period of interest is about 2.4%, which needs to be considered. Part of the question that I had when I applied for the Nuffield Scholarship was trying to understand or trying to find some more data on farmland pricing. And there is now several reports that analyse Australian farmland movements, such as the Rural Bank report, Rabobank's report, Elders and other real estate agents. These reports go to varying depths, and I find them all of value. I'd recommend that anyone who has interest should have a look at them. I'll be adding all of the links to all of the reports I've read when I submit my report, hopefully in December. These reports are all broadly telling the same story, but continuing to grow in detail. Here is an example of the innovation that some of the reports are providing. This is a Rabobank report released last week, and it gauges the value of land per millimetre of rainfall. The per millimetre of rainfall comparison has been used quite a lot, I know privately, but also in institutional circles for a long time. But this is a great addition to, I suppose, not transparency, but data available to the public. So it's great to see there's a lot more talk about farmland. So when these reports started to be published, I thought, well, this will make my study easier. I was wrong, and that's because what I found, and what I know many of the scholars find, is that the more you learn, the more questions that you have. So what was my next question? It was trying to identify the influencing factors on farmland prices. My simplistic view was that it was interest rates, production and commodity prices, and right in the middle there was where you get the most amount of bang. Much has been written about the influence of interest rates, but analysis by Rural Bank in 2020 found that commodity prices had the strongest correlation to farmland growth. This goes counter to my theory that production was the key driver. There are assumptions with any scenario that are going to vary the outcome. Originally, I wanted to identify each of these components at a micro level, but after starting with interest rates and going down the rabbit hole of looking at debasing currencies, and then onto experiment of quantitative easing with stimuluses through the GFC and the pandemic and modern monetary theory and cryptocurrencies, my brain really started to hurt. So I learnt a lot, but I don't think it was really helping me to answer any questions. Similarly, trying to gauge gross margins in different farming areas and price arbitrage between those locations didn't explain anywhere near enough about why land values were taking off at such a rate. So I opened my mind to the possibility that maybe there just isn't a predictive algorithm and that maybe it's complicated. Realistically, it's complicated, and it's a combination of all of these factors on the right-hand side, plus probably another dozen as well. Each one of these is going to be different for the person sitting next to you. We'll move on to the risks and rewards that I've identified. We know that over the last 15 years, capital gains has contributed largely to the balance sheet health of farming businesses. But what were and what are the risks and rewards of investing in farmland? Quite simply, in my opinion, there are only a few risks to investing in farmland, but their impact could be catastrophic financially. Due to its capital-intensive nature, many choose to purchase land using debt funding. When you employ leverage as a tool to magnify financial outcomes, we generally associate it with depreciation, but it can magnify the downside risk also. Highly leveraged assets often become sensitive to changes in valuation, and this has become the main source of wealth creation in recent years. The risk is that these assets decline and equity is eroded. Should this occur to a level where you or your financier choose to liquidate the asset, the realised losses can be significant. There is a multitude of reasons why asset devaluing might occur, such as industry disruption. Think about live export ban in 2012 or the potential of foot and mouth disease or the outbreak of foot and mouth disease. For this to occur, we would need to see severe and sustained reduction in the buy-side function of the market or a large liquidity event on the sell side. It was interesting speaking to a North Australian pastoral valuer who noted that despite the live export ban being devastating both financially and socially for many farms, being devastating both financially and socially very few farms were forced to sell. There were some, but certainly not as many as were expected. That was with the live export ban, sorry. Now, this could have been for a number of reasons, such as low debt, but it was an interesting observation. So certainly being forced and liquidating out would impact the supply of the land onto the market. From my studies, the identified risks of this would likely occur from reduced revenue from both sustained lower prices and lower yields. This would make ag less attractive, and those with debt would find servicing difficult, especially if it was a higher interest rate environment. Related to the risk of leveraging is the issue of servicing debt. One of the biggest skeptics of current land values that I came across also conceded that in his view, in the longer term, farmland will continue to appreciate, albeit at a slower rate. So how do we stay in the game until our equity builds? There are no guarantees, but having a continued focus on productivity and profitability are the best means to ensure financial commitments are met. In my opinion, this principal focus should be upheld irrespective of your debt position. The rewards. Well, I think we all know the rewards. The rewards are riding the recent wave of appreciation. None of the interviewed asset owners or managers expect to continue at this rate in the near future. A reward that was highlighted along my travels was that unlike many other assets, farmland is commonly leveraged when it appreciates. Owning farmland and operating it can provide you and your business confidence to invest in its productivity, knowing that you control its future use. This is not always the case with leased land, so that's a strong point of difference in owning land versus leasing it. Learnings from my travels. I was on the Japan GFP, and then I stayed in the US for a month and did some personal travel, but I've been lucky enough to have several Zoom meetings with fund managers and large farmland investors across the globe. Buying farmland has been an exceptionally good investment historically, especially in an inflationary environment. A large REIT manager, real estate investment trust manager in the USA said, "Land is like gold, but with a coupon," meaning it is a hedge against inflation, but it also earns a yield from this investment. You don't have to sell it to realise it. It's better than commercial real estate because it has 100% occupancy. Get into the market. And by this, I mean you've got to find a way into the market. It's a problem that many in the housing market have experienced, and that is that by the time that you save for a deposit, for such a large deposit, often by the time that you save that amount, the goalposts have moved. Fractional ownership models, such as Acre Trader in the USA, may be a way for aspiring farmers to participate in capital gains whilst they build equity over time. This is also a method for farm succession. Build sweat equity by way of lower wages for growth in the asset in the future. Focus on profitability. A large-scale cereal farmer in West Kansas made what I thought was a really good point. If you focus on the profitability and maximising efficiency, you will have the maximum number of options to either lease or buy land on your terms. He has a balanced approach to his owner, operate and lease business. He generates fantastic cash flow, cash returns, and depending on how he views the market locally at the time, he has every option available to him to either buy or lease land. He is the master of his capital allocation. Be innovative and inquiring. I've come across several successful farmland owners who have thought outside the square when looking at financing farm purchases. These all required asking the vendor what they wanted to achieve and what time frame they had to finalise the transaction. When capital gains is rising quickly, time is your best friend. So vendor finance or deferred settlement can be of huge advantage. The GFP highlighted to me the attraction of Australia as a destination of real asset capital. There is approximately 75 trillion with a T in institutional investments worldwide. That's pension funds, etc. This grows by 7 trillion a year. In the 1990s, real assets, where farmland fits into that portfolio, accounted for 5% of this sector. By the 2000s, this had risen to 15%. It is now expected to rise to 20% given its performance over the pandemic and the inflationary environment we are in. This capital requires a destination that has strong legal security of land title, has a democratic government with low sovereign risk, has a scale of transaction of $100 million plus, and has geographic and enterprise diversity available. That destination, in my opinion, is likely to be Australia. Model all the numbers to know what the sensitivity to different scenarios are. My learning is that economic circumstances change. Be prepared for the financial strain or opportunity that these events present. Thank you again to Westpac Agribusiness for your support. And lastly, but by no means least, thank you very much to my wife Sarah, our son Jack, and our soon-to-arrive daughter for their support over the Nuffield experience. Thanks very much.